another power-packed episode.
Everyone's talking about Farcaster right now. Farcaster frames that I had mentioned, and this is what this looks like. Super interesting. ENS. This was in the news as well.
Blockchain is triple entry accounting system.
Centrifuge is the largest in terms of like the total collateral, and these are some of the loans that are out there.
This is new age finance.
Eventually, some like a large asset manager like BlackRock or something is going to eventually do that.
People still do not know how to interact with Web3. Tokenization and hopefully real world assets, and probably in a decade's time, is the future of finance. Welcome to another episode, Michael, and everyone, to the Rundown. This is episode 13. This is the end of quarter one, right? End of quarter one for the Rundown. How does it feel, Michael?
End of quarter one. We are, we're into Q2 for the Rundown. Episode 13 feels good. It feels good. I think things are moving along. I think hopefully people are pleased with the direction we're going. We've had our first guest now as well. So yeah, excited to be back for episode 13.
And I love it that we are in sync when it comes to what we are wearing. I know I always get that a lot, that don't I have any other color apart from black? And today you are black on black as well, Mike.
Yes. Yeah, I figured we got a match. So, and I could tell your hair looks great as well today. So
Cool. Thanks, man. Thanks. So how good was the episode last time, man? Like having Juan on the episode, somebody, how the company has been at the forefront of Bitcoin ETF. Power-packed episode. We got amazing feedback on both of our socials. We learned a lot as well. The industry, less than a month and more than $6 billion in inflow. Great start to the ETF as well.
Yeah, no, I think that was super interesting to have him on. Like I said, Bitwise is an asset manager that's really crypto native and probably maybe a little bit less known to like some of these other like larger TradFi firms. That some of them have been in the space as well, but it's great to highlight some of the work that they're doing. And yeah, being forefront with the ETF, I hope people got some good insights to some of the mechanics that are going on with the ETF, just going through the numbers of everything that's kind of gone on over the last few weeks or so. And then obviously we broke down the investment advisor survey that they had done Q4. So if people haven't listened to that episode, highly recommend checking that out.
Absolutely. And again, just like usual on the Rundown, another power-packed episode this week that we've got for everyone. We're going to talk about the Friend.tech new social networking app, which is on the decentralized internet. Farcaster. We're going to talk about ENS plus GoDaddy. We're going to do a masterclass on real-world assets. And I know, Michael, you've got all of your charts and everything fired up so that we can see some visuals, some smart wallet interactivity, going on chain as usual, the crowd favorite as well. So for everybody out there who's listening to the podcast on audio, what are you still doing? Subscribe on the YouTube and start seeing everything visually, especially with what Michael brings to the table along with Token Terminal.
Yeah, I'm excited. Action-packed episode today. So why don't we hop into it? I think, I've been seeing, it's fascinating to watch the crypto sort of news cycles over the weekend, and maybe towards the end of last week, we started seeing a lot of people talking about Farcaster, as you mentioned, and I thought it would make sense to just touch on this. I don't want to chase these narratives on this show like kind of everyone else does, but at the same time, when something new comes up, it definitely makes sense to, have your eyes wide open and kind of observe what's actually happening. Yeah, let's talk a little bit about Farcaster. I want to pull up some data here as well from Dune. So let me share my screen. As we can see, these charts are pretty impressive looking, and this is part of the reason why we see so much activity, on crypto Twitter, within a lot of the crypto media outlets. Everyone's talking about Farcaster right now, and it's because the, active users and just the general engagement on the app is way up recently. Now, this looks like, like the numbers are going off the chart. Important to realize, like, there were about 5,000 daily active users on this. It's a social app, so that's really small for a social app, and that has spiked up to 25,000, daily active users or so. In total, Farcaster has about 140,000 like total signups, in total. So this is like still extremely small. However, it's gaining some traction. I am on Farcaster, so people can, if anyone's interested, it did just recently open up to the general public, so anybody can go on there and create an account. This is built on top of Ethereum, and I think it's using Optimism as the layer 2, and you can connect your Ethereum wallets to your username on Farcaster, which is one of the interesting things. But I think like the big question for me is like, what is the key benefits to Farcaster over something like Twitter, and why would a like non-crypto native person care about this new social media app? Because if you go on Farcaster today, it looks like crypto Twitter, essentially. It's mostly Ethereum folks, Vitalik is on there. So what's interesting about it is there's no bots, right? There's no bots. The conversations are very civil. You don't see the same type of behavior on there that you do on Twitter. So those are some of the benefits. What would be interesting about this to somebody who's not crypto native, right? And that's where kind of the blockchain comes into play, where we've seen censorship on social media applications. So that's something that this can solve. Your social graph ultimately gets tied to the blockchain on something like a Farcaster. And so like if you decided that Farcaster, let's say you built up a following on Farcaster and you had 50,000 users or something, and then, 50,000 followers, and then say, maybe another app comes out and that one is doing even better, you can bring your followers from Farcaster over to that new app. And that's what's kind of interesting about this new social graph. You can't do that today. Like Twitter is not interoperable with Instagram or LinkedIn. So those are some of the kind of the interesting potential, reasons why somebody might come over. And then the other thing is like they just introduced this concept called Farcaster Frames. And this, to me, this is actually what got my attention, got me pretty interested. What this Farcaster Frames is if you're on a social media app, and I do this all the time with the DeFi report. So I'm on LinkedIn, I'm writing a report covering an interesting topic. I'm promoting that report, and I want people to subscribe so that they can have the report land in their inbox once it's published. And LinkedIn does not like me sharing something that takes users off of LinkedIn, right? So if I share a link to get people to sign up, they're probably going to like suppress my post because they don't want that going viral. And everybody knows this. That's why people put their links typically in the comments on something like LinkedIn. Twitter has had the same issue. Elon Musk has been really almost like shadow banning this type of activity. If you're trying to get people to go onto Substack on Twitter, like he's really blocking a lot of that. So there's these little like wars happening where the social media sites are trying to keep all the users blocked in on their site. What Farcaster is saying is like, that's silly. Like we're going to allow the users to actually embed their forms right through a social media post. So for me, I wouldn't even need to send my users to another landing page to sign up. They could potentially do it right in the interface of the social media app. That's pretty interesting. That's something that caught my eye. And maybe we can just show that real quick.
It looks like Twitter in a way.
It does. It just feels like a social media app. You've got you've basically got your trending right here, which is basically what you would see in a feed, just like you said, like on Twitter or LinkedIn or something. And you have all these various users. This is the Farcaster Frames that I had mentioned. And this is what this looks like. Super interesting. So you could imagine you're putting a post up, you want to promote, you have a newsletter or something, and you want people to sign up. Your sign up form could just be right here. And you don't have to take people off of the actual social media app to sign up. You can also just mint an NFT. Like let's say I was going to publish an issue of the DeFi report. I wanted it to be, and I allowed 20 NFTs to be created out of that post. You could just mint an NFT right here natively. And now your wallet is already connected to your account. And now you own that. So pretty interesting. I could tell your brain is starting to spin a little bit, Shiv. Kind of interesting. We'll see where this goes. Like I said, it's still super small. There's, 25,000 daily active users or so. But yeah, curious to get your reactions. Are you going to check out Farcaster?
Yeah, look, I'm going to check out Farcaster. I remember that when Meta's Threads app came, and I was looking and digging deep as to what their future roadmap is, they're thinking to also make their Threads app a decentralized version of it. They didn't mention anything around what blockchain they're going to use, but they said that people who have got Threads followers, they can take their followers to some other social platform. I forgot the name of the technology that they were going to use, but they said that that's part of their roadmap. They believe in the decentralized version of the roadmap. Now, quickly, when I saw this and you mentioned about minting, I'm like, my God, are we going to reach again that stage where everybody's just going to mint anything? Like, there was this stage during the hype cycle of NFTs where people were minting tweets and it was getting sold for millions of dollars. And then after a year, that same tweet was being sold for $20. So are we going to see some hype cycle like that? And just quickly, interested to get your take. I see something written over there as base. Does that mean that people have got the choice to mint their NFTs or like have their NFTs on any sort of a blockchain layer? Does that base mean it's on the base blockchain, or what is that base?
What that is indicating is the channel, actually. So the way that they sort of segregate and categorize posts within channels, and like this is the channel tab. So if you went to, there's a channel tab for base. And so that was a post that just tagged itself to base. And that's kind of why you saw that. But in terms of like the infrastructure underneath here, I believe they're using Optimism as the layer 2. They are going to be rolling this out onto Solana. So it is based on Ethereum right now, but I think actually like this week or next week, it's going to be rolled out on Solana as well. So that gets interesting because now if you have a Solana wallet, you can start to do things there, but then you need that interoperability where the Ethereum wallet can interact with the Solana wallet. So you can see it's still, there's still layers of complexity that are going to need to be solved on top of this, but there's some features here that I think are kind of interesting. And we'll just see, like, it is interesting to me that like this could start to like create this more decentralized social media landscape where we saw, in the last election cycle where Trump was kicked off of Twitter. Like, imagine if he was able to just bring all of his followers he went to another, he created his own social network. Imagine if he could just bring everyone over. Like all of a sudden you just took all the power out of Twitter. So interesting to see how that play out. I mean, what ended up happening with like Twitter was before Elon Musk bought Twitter, there were a lot of concerns about censorship on Twitter. And at that time, there were entrepreneurs, there were a few other social networks that were spawned that were sort of catering more to like conservatives. And that was kind of interesting to see that happen. And they gained a lot of traction early on because people that were upset with Twitter, that were feeling like they were being censored, made the move, but it didn't go to the mainstream, right? Like that, it didn't really catch on. And so we'll see, like, this is right now capturing the crypto native attention. For me, the main thing is like, how do you get somebody who's not crypto native interested in this? And that's when it could potentially go mainstream. But
we can have Steph Curry or Donald Trump entering this and suddenly everybody would be like, check out the new social networking.
But it is interesting to me. We talked about Friend Tech, that sort of, that's another one that's on Ethereum, slightly different model. It did capture the narrative as well. And so you can kind of see how social media can go viral quickly. And so I still think there's something here. You can see there's clearly something here. And Farcaster is definitely onto something. There is no token for Farcaster or anything like that right now. You do have to pay $5 to set up your account. And the reason they do that is they're trying to reduce bots. They just don't want the bot activity on there. So exciting development. We'll keep an eye on this. Yeah, so let's move on. There's one other topic I wanted to bring up, and that was ENS. This was in the news as well this week. ENS just did a partnership or an integration with GoDaddy. And if people are unaware, ENS is Ethereum name service. So this is just a way to, make your wallet address, which is a string of letters and numbers, make that human readable, right? So then you could be shiv.eth, and then I could send you an NFT. I could send you payments much easier than anyone who's ever done a transaction knows how scary it is typing all, with blockchain native addresses. So ENS is solving that issue. Now what you can do with your ENS domain is attach that to a Web2 domain through GoDaddy. So the DeFi Reports domain is through GoDaddy. So I'm going to be looking into this myself, but kind of interesting because now all of a sudden you've got some interoperability between Web2 domains and Web3 experiences where you can tie payments, you could tie digital content, you could send an NFT to a website address. Who knows? Who knows where that really goes and what types of apps could be built there, but an exciting development. I wrote a report covering ENS last year. I want to say it was around this time last year. because I was looking at the total number of Ethereum wallets and then the total number of ENS domains, and basically thinking like, okay, there's a huge gap here. This gap needs to close. And so I was bullish on ENS, still am. So full disclosure, I am an ENS token holder. But yeah, curious to get your take on this.
Yeah, look, just quickly, whenever anybody does MBA anywhere in the world, at least from top tier colleges, they teach you a framework called Crossing the Chasm framework, which we have covered a number of times in our podcast as well, Michael. So I know you're familiar with it. But for a lot of students who are subscribers to the DeFi report, as well as to the Rundown podcast, Crossing the Chasm framework involves that the first 2.5% are the innovators phase. And after that, we move to the, early majority, the early adopters, actually. After the innovators phase, we move to the early adopters. ENS and all these decentralized social protocols, as well as like ENS, this is like decentralized domain name service, right? It's Ethereum name service, but it's effectively a domain name service for it. They were the innovators, and now we're seeing the chasm getting crossed where the bridge between Web 2 and Web 3 are coming to find out ways how we can create early adopters. So to me, we are seeing crossing the chasm for Ethereum name service right in front of our eye with this partnership. Anybody who's a webmaster knows about GoDaddy. They are number one in India. They're number one in Australia. I'm pretty sure they're number one in the US as well. For them to do partnership with the ENS indicates to me that we're now entering the early adopters phase, and we're going to see a lot of Web 2 webmasters going to use their hands and going to buy Ethereum name service names for themselves, interact with Web3, Ethereum, MetaMask, and all the other smart wallets. I think we're going to see a lot of early adopters in the decentralized web from now onward.
Yeah, I would agree. When I was really studying ENS, I mean, it's interesting because there's so many parallels between just the way that like website addresses ended up, once we introduced domain name service and the ability to register a domain and make it human readable, then the internet kind of really took off. But like we were using a string of numbers to identify websites before that. Just like, so the internet was incredibly pseudonymous, right? And what is Web3 right now? It's pseudonymous. We have the same issue. So when you looked at that, I was like, oh, this is just a repeat of the way the web developed. And if you think about it, like, how did we start to come up with identity in Web 2? It really ended up with, I would say, like, you had web domains, but not everybody owns a web domain. Everybody does own an email address. And I sort of think everyone's going to own human readable ENS address. I don't know if it's ENS, maybe there's another service provider, but like, you got to think that if Web3 takes off the way we believe it ultimately will, that basically everybody will have an ENS domain. So go get your domain, lock up Shiv. I don't know if you already have Shiv now.
I already have it.
You have it? Yeah, awesome.
Have it.
Yeah, get proof of work, lock that stuff up because we're early. And I think this ultimately is gonna, and I like ENS because they're really well kind of integrated with like the Ethereum Foundation, and they're just like one of those really important protocols within Ethereum. So we could probably move on to our session on real world assets for the show.
This is exciting. So I'll before we start that, I want to tell you what's happening between India and Australia. I'll talk about India first. So as you know, India, it's like soon going to be the third largest economy. The number one economy is, of course, US. Number two is China. Number three, soon it's going to be India by the end of this year, according to projections. At the moment, it's fifth. But Japan and Germany, they're probably going to get kicked out the way India is growing. 7% GDP every year. They're probably going to kick Germany and Japan out. So there are a lot of, it's a big economy when you think about it from a nominal standpoint. And the infrastructure is still, comparatively to Japan and Germany, still less electronic. And that's what they're trying to do, digital. So there is a lot of work being done over here, especially among the public sector, not the private sector, on making sure that real world assets in India gets tokenized and goes on chain, but on a private blockchain operated by the government. That's what their vision is. In Australia, there are a lot of people talking about real world assets as well, on how we can do things on chain. The Australian Stock Exchange, they failed in their attempt, but they were trying to replace their stock exchange matching system onto the blockchain. They spent like multi-millions of dollars and decades actually, but they failed at it. But the point that I'm making over here for the rundown viewers is that this topic, real world assets, is not just an American topic. Pretty much all major economies are talking about it, which is on how to put real world assets, and there are multifold of real world assets, which we're going to discuss, but how to make real world assets on blockchain so that things like land grabbing, which still happens in India, by the way, and happens in Africa, can stop happening. We reduce friction, and there is efficiency in transaction. So super important topic. We're covering it for the first time on the rundown. Yeah, can't emphasize enough. So Michael, let's talk about real world assets.
Yeah, no, I appreciate that. And I agree. I mean, it's a fascinating topic. It's one that we've heard about for years now. And I think, we saw, everyone likes to put out their predictions for the year or their year-end recaps. And, a lot of people talk about real world assets. It's been hyped for a long time now. And I think the reason for that is it's so obvious why blockchains can be incredibly useful when you think about all of the value. And even if you just looked at the private markets, I think most people don't realize that like the private markets are much larger than the public markets and the public equities. So private real estate and private credit, like these are $100 trillion asset classes. And one of the major problems with that is you don't have liquidity. When it's a private asset, there's no like market to trade that thing. And so there's like these illiquidity premiums, right? If you want to access those types of assets, you need to lock up your capital for 5-10 years. And there's just so much friction with that space. There's accredited investor rules. Why can't retail access those types of investments? It's just so obvious that that whole space needs to be upgraded, and this technology can be the catalyst to do that. But yeah, maybe we should just take a step back and just like define real world assets, sort of a broad. In crypto, we tend to come up with these kind of this odd nomenclature every once in a while. But yeah, I look at it as just any asset that is existing in the real physical world. So it could be anything from real estate, private credit. It could even be like just a stock or a bond or something like that you want to tokenize. Could be anything really. When you think of like the world of value, if you put it on a blockchain and you represent it as a token, and now it's on the internet, and you could potentially like create a market around that. That's really what we're talking about when we're talking about real world assets. And I think what are the sort of like benefits of this? Like we're starting to see like Larry Fink, talking about tokenization and putting things on blockchains. I think the reason for this is blockchains are, and I have an accounting brain. I spent years doing accounting and finance. And so just thinking through like how you account for things in databases and reconciliation and sort of where all the assets are stored today, they're all in private databases that are not interoperable with each other. So just from an accounting perspective, if you tokenize these assets, put them on a universal global accounting ledger, the things that you can start to do with them just get very, very interesting. So I think that's one of the sort of obvious reasons why this should happen. You have smart contracts, which can start to automate a lot of things and really create efficiencies. When you think about managing a fund, for example, let's say you have a fund of real estate assets, and funds have distributions and capital calls. And so if you have a distribution and you can automate that with a smart contract and kick out your distributions to all of your LPs automatically, and everything gets tracked and accounted for using public blockchain and smart contracts, that can just drive efficiencies. You're removing middlemen and just like kind of, improving that process. Of course, we talked about democratizing access. If you can tokenize something, you can fractionalize it, all the way down to like $100 units. Anybody can access interesting investments. Maybe I can buy, into, a skyscraper in Dubai or something with a small amount of capital. That's sort of the best kind of use case, the best scenario for where this could potentially go. So those are some of the reasons. Is there anything that I'm missing there, you think, just in terms of like the benefits of this?
No, but I just want to make a quick point over here. So my first class of blockchain at NYU Stern, the first class, Professor Ian D'Souza said, I want somebody to come near the board. And I volunteered. I came near the board. And he told me that create a double entry accounting system. And I created the double entry accounting system. And then eventually he showed within 15 minutes that how blockchain is a triple entry accounting system. I just want to make a quick point for all those people who think accounting is not a sexy subject. The reason why people don't think accounting is a sexy subject is because double entry accounting system was invented thousands of years ago. And since then, there has been no innovation in accounting apart from the change in laws that happen in jurisdiction. Blockchain is triple entry accounting system and the first invention in accounting in thousands of years. So it's great that I've got Michael, who's got an accountant's brain, because honestly, nobody understands blockchain better than an accountant from a conceptual.
Yeah, that is a great point. I've actually found this for whatever reason, because accountants are used to thinking about just reconciliation and data and databases. Like they tend to just like intuitively kind of grasp why this is important. I find engineers, it's probably similar sort of way of thinking.
You know why I also got it? Because in my undergrad, I did economics, finance, and accounting as my major. So I've got an accountant's brain as well somewhere.
I mean, accounting, honestly, I mean, not to go down the accounting path here, but like it really is like everything. Like even money is actually just an accounting system, like that, like the way we're just doing accounting. But yeah, it's a deep subject, but this is just a better accounting system for assets.
So for all those people out there who are listening who think that accountants can't be sexy, just look at Michael and me. We got a sexy brain over here.
So maybe the next question here is like, you know, how do you tokenize something? Like people are probably wondering, you know, if you've got a basket of real estate, like, you know, how does this actually work? How are people doing it today? What we tend to see, and like this is kind of the path to this, is what you do is you take those assets and you put them into a legal entity. So like a special purpose vehicle. And now that legal entity owns the assets. And then what you're doing is you're tokenizing that legal entity and then allowing other investors to come in and purchase individual, you know, tokens that represent interest in that. So like, I think the takeaway in just sort of the way that that's being done, and there's probably not a better way to do it. Maybe we'll see something come up. Once you start to involve the real world, there's a lot more friction that comes into play. And, you know, when you issue something natively on a blockchain, when you issue Ethereum, did their initial block mint at Genesis, like that was just natively on the blockchain, right? You're not involving like legal contracts and all these other things. So just a lot more friction generally when you're dealing with real world assets, existing securities, you know, securities laws, accredited investor rules, and all of this. There's just a lot more friction. This is one of the reasons I think this is going to take a lot longer than probably people even realize today. But maybe it makes sense, Shiv, from here just to go into a little bit of data. I can pull up just some of the growth we've seen, like from just like U.S. Treasuries, private credit, kind of where we see that space going. There's a few apps that we can talk about. MakerDAO is doing a decent amount with real world assets. That makes sense?
That sounds perfect. And this would be so useful, especially for the Rundown international audience, because I know you've got a big following from the DeFi report who watches the Rundown in Europe as well. But there's just amazing activities happening in the US real world assets market with US treasuries being put on chain effectively. So I'll wait to see it.
Yeah. So let me pull up, and this is actually coming right out of the Ethereum investment framework. All right. So yeah, again, this is actually coming right off of the Ethereum investment framework, and shout out to Security Token Markets, who actually did a little guest writing section here. Recommend Security Token Markets for people that are trying to learn, their advisors in the space, trying to learn about how to tokenize and how to do it compliantly. This is treasury growth, and this is only looking at Ethereum. So there is some activity there's one other blockchain where we're seeing, one other public blockchain where we're seeing treasuries put on chain, and that's Stellar. But this is strictly looking at Ethereum. And for the year, you can see there's decent amount of growth, I guess, just last year, but over 500 million in US treasuries, you know, on chain. That is a drop in the bucket, you know, in terms of the entire like treasury market, obviously. But it's interesting to see that this is starting to happen. These are some of the protocols that are doing this today. So you've got Maple Finance, TrueVibe, Backed Finance, Ondo. The major ones right now are Ondo, Matrix stock in the green, and then Mountain Protocol saw like a pretty big run here, just like in Q4, or really a December or so of last year, in terms of putting a bunch of assets on chain. So this is just kind of an idea of like what's happening with treasuries. Why are treasuries going on chain? For the reasons that we just mentioned. Like it just kind of reduces friction. If you've got a stable coin that isn't paying you any yield, and you can start to get the functionality of these on-chain treasuries that you could have with stablecoins, then all of a sudden Tether and USDC, I think, are going to start to have to offer a yield at some point. And that's where I think this growth is still so small that it's not really eating into the stablecoin market. But I think eventually it does, because, once somebody comes out and gets good amount of adoption and they're sharing the yield as they should be with the holders of the assets, then that changes the game. We aren't there just yet, but that's what I'm expecting to see eventually with treasuries. But yeah, curious to get your thoughts.
Yeah, just quickly, based on, you mentioned a whole list of benefits. I mean, we're probably going to see some of these protocols, and you're going to show these protocols live on the web browser as well, on some of the features of it. But if somebody wants to access treasuries or trade treasuries, it's a very closed system. You need access. If you want information about those, you need, access to Bloomberg Terminal. If you want to trade those securities, you need a brokerage account. You need a lot of money that you need to showcase with the Goldman Sachs of the Wall Street brokers. But now, what this does by having treasuries going on chain is that it democratizes the market. You need to have a wallet. You need to follow a few protocols of the respective DeFi protocol. So if somebody wants to do it at Maple, they'll need to follow some KYC, I assume, interact with the smart wallet. But that's it. I don't think Maple is going to ask the smart wallet user that, do you have $50 million? They might ask, but I think the future of this treasury or other real world assets is that it's going to provide the markets to retail audience. And that's true democratization.
Yeah, I would agree. And that brings up some interesting points too. One of the reasons that DeFi is all over collateralized today is because of the volatility of the underlying assets. So if you want to get a loan in DeFi, you're using Ethereum as your collateral, you need to over collateralize to access that because of the volatility of ETH. Treasuries start to grow and to proliferate. Now all of a sudden you can take your treasury, your tokenized treasury, and go into DeFi and get a loan, and you're probably not going to need to over collateralize that because that doesn't have the volatility. And so ultimately what that leads to is more capital efficiency within DeFi. So that's kind of where this starts to get interesting, is where that intersection with DeFi as well. And that's something I'm looking for. We'll see how it goes. I think we'll probably do an episode on just the stablecoin market as well at some point and compare what's happening there, because the other part of this story is that stablecoins and what we're seeing here with the growth in treasuries on chain, incredibly small, certainly still, but on the margins starting to create demand for dollars and dollar-based debt at a time when foreign central banks are buying less. So I think that's kind of interesting, and we haven't really seen other jurisdictions really get involved just yet. And most of the stablecoin, like 99% of the stablecoins out there, are backed by dollar-based assets and not euros or any other currency. So yeah, moving on real quick from just treasuries. Again, this is just another section in the Ethereum investment framework, but this is private credit. It's still, again, super small. We've only got this is, again, just Ethereum, about $450 million of loans, issued based on private credit that's now on chain. These, again, some of similar names showing up down here. You've got Maple Finance, Ribbon, Goldfinch. Centrifuge is the largest in terms of the total collateral. Okay, so we're going to jump into MakerDAO first. We'll go to Centrifuge next. And I'm just looking at some Blockworks research data here. We're looking at MakerDAO, and we're looking at real-world assets, in particular real-world assets that MakerDAO is lending against. And this is a growing part of MakerDAO's total revenues. It's starting to really be a meaningful percentage of their total revenues. This is part of why I think this real-world asset narrative continues to sort of pick up, is because MakerDAO is actually doing stuff here and it's growing. And you could see there's over $2 billion of collateral that MakerDAO is lending against in real-world assets currently. And you'll notice, I just pulled this up, you'll see Block Tower sitting in there as one of these are all of the firms that have gotten loans, that have put up collateral and received loans, where basically MakerDAO is minting DAI against that collateral, and that's growing the amount of DAI in the market, and then these borrowers are paying interest back to the protocol.
So just quickly on that, Michael, especially for our viewers as well, MakerDAO is giving out DAI, which is their stable currency, DAI. They're giving it to these entities, and we are seeing this information on Blockworks research. So does that mean that MakerDAO has put this information on public, or they have marked these entities' wallets, and from there, Blockworks research is getting this information? Like, I just want to get an idea for how is this getting calculated?
Yeah, good question. I'm not exactly sure how Blockworks Research is getting access to this, because this is essentially, and it's probably because MakerDAO is making this public on terms of it. I think they have to. They have their governance, and everything needs to be pretty transparent there. And I think that's really where it's coming from. It's not all exactly coming directly off on chain. I could be wrong about that. Every one of these entities that we're looking at here had to create a governance proposal in MakerDAO, and then basically tell MakerDAO what their plan was. Hey, these are the assets that we have. This is why we think that you guys should lend DAI to us, because what they're ultimately doing is taking that collateral in and then minting DAI on the other side of it. And then these guys pay interest back to the protocol, and that's the revenues for MakerDAO. But yeah, I mean, I think what we can do, so you see Block Tower has about $132 million of loans or of collateral that they put up to get loans from MakerDAO, and we can connect this to Centrifuge, because MakerDAO is then basically executing that through Centrifuge. So let's hop over to Centrifuge. And, you know, on the previous chart that I showed from the Ethereum investment framework, Centrifuge had the largest chunk of private credit issued on chain, the 270 million. So we see that here. We're now in the Centrifuge app. Of that 270 million, this is some of the loans that are being issued here. So Block Tower, we saw Block Tower on the previous screen. They are essentially getting loans, and then MakerDAO is issuing DAI against those loans through here. And they're just executing that through Centrifuge, which is basically this marketplace where if you have real world assets and you're looking for a loan, you can, you know, put those assets on this platform, and then other people can come over and give you those loans, and then you're paying them directly with interest. Centrifuge, as the platform, takes a small cut of that as their business models. That's sort of the full, taking it a few extra steps from what we saw on the initial chart there. Any questions, I guess?
I think this is great. I know that a lot of viewers would be seeing this and they would be like, they don't understand what this is. But this is good overview that we are showing, because this is new age finance. These private credit markets, you don't just study an undergrad and then get access to these private credit markets. You need years and years of experience working in corporate banking. You need to be a CFA, you need to be an MBA in order to get access to the private credit market and understand the dynamics of how it works. That's why private credit markets, not many people know what it is. Precisely for that reason, because it is not a public market, and in order to get access to it, you either need to be a billion-dollar company or you need to be somebody who's a multi-million-dollar man or woman, and you know, have these Wall Street machinery brokers in your jurisdictions to give you access to it. But what you're seeing over here is private credit market on the blockchain. So don't get confused when we are showing you all this. Use it to not only learn these on-chain finance, but also to learn what is private credit, which is an advanced topic of finance.
Yeah, and like, you know, kind of interesting. I'd like to see more of this, where we actually have people that have like basically accounts receivable that they're putting up as collateral. It's essentially someone's going to pay an entity, you've got money coming in, but you need liquidity today, you need a loan, and then that receivable is kind of the backup there. So kind of an interesting, that's a little bit of like interesting innovation. I expect to see more of that type of stuff through Centrifuge here. But again, we mentioned before, like once you're going a step off chain and you're involving these real world assets, like if you're going to come in here, and this is part of the friction that needs to be overcome. If I'm a lender and, you know, I want to come in here and I think this is a nice yield, you know, I want to access this, are you more likely to do it here? You know, how do you see what's behind these assets? Where's the data? Like, how do we, like all the legal contracts, there's a lot here that I think gives me pause. And I think this is still incredibly nascent. And that's one of the challenges, I think, with this space, is just connecting all of those dots where an investor feels really comfortable. We can access the data underlying, you know, I would love to see, well, what's behind this accounts receivable? Who's paying that bill? Do they have the money to pay that bill, right? You need to have that data to come in here and put your capital up. And I don't think we're there just yet. I'm probably a little less, I'm bullish on this stuff, but I think in the short term, still pretty challenging. Just a lot of the frictions that are out there. Shall we jump into the terminal? Is it time to jump in the terminal?
Time to go on chain with Token Terminal, is it, Mike?
I'll see you on the terminal. All right, we are in the terminal here. So just to take this all sort of even a step further, looking at MakerDAO here. Now we're in the terminal. We showed, MakerDAO and some of those assets and those loans that they're minting DAI to create, and that's their business model. So somebody comes in, they want to get a loan, they put up the collateral, the governance forum votes on that, they decide to issue that loan, and then the borrower ends up paying interest back to the protocol. And then, so that's what we're seeing here in Token Terminal in terms of the total fees. That is the interest that's being paid against that DAI. $136 million of interest just in the last year or so. So a lot of this is starting to come from issuing those loans on real world assets. So we'll see if this continues. They did a deal with Tesla last year where Tesla was building out, I think, real estate collision centers in the US, and they got a loan in DAI. Why did they do that? I think what's interesting here is because of the efficiency, hopefully more efficiency with MakerDAO, they're able to issue loans at a lower interest rate. They're able to undercut traditional finance. And that's what gets interesting. And for them, they're happy to do that because they just want to grow the amount of DAI that's in circulation, because that's what they're getting paid against. They're getting their interest payments on. So we'll see. There has to be less friction. There has to be less overhead costs for them to be able to do that. So we'll see if it continues. But a lot of people are looking at MakerDAO as the sort of DeFi protocol that can really step into this real asset business.
The decentralized stablecoin for the Web3.
Yeah, exactly. And then, so we talked a little bit about some of those other protocols that I showed on the initial chart there. Want to jump into Goldfinch as well. Goldfinch is sort of similar to Centrifuge. So private credit market, people could come in here, put up assets, and then others can lend on those assets. And then the borrowers pay, interest directly to those lenders. And these marketplaces essentially just take a small percentage of that, those interest payments. Goldfinch has about $83 billion of active loans on the protocol. We are in the app currently, and these are some of the loans that are out there. Now, if we step back into the terminal, again, we can see those active loans here. There's the 84 million, and then you can see the total fees that were paid on that. That's a pretty high interest rate, $11 million in fees on the $84 million of active loans. And again, the business model, I'll just pull that up real quick, is you have the borrowers, they're paying those interest payments directly to the lenders, and then Goldfinch just takes a small cut of it. And that's why we're seeing the 11 million there. If you wanted to only see Goldfinch, so this is the total fee. So you have the 11 million as a total that gets paid out. And then the 1.1 is what gets paid to Goldfinch protocol itself. That's the sort of the DAO revenue there. So that's just kind of taking it all the way through here.
I have known Goldfinch for years now. I think it's a very old protocol. It's one of the early DeFi credit protocols, and I've been following. I like Goldfinch as well. I think they, from their first version to now, they've got more assets. Their UI UX is better. Their functionality are better. But the question still comes from a lot of skeptics of DeFi, which is that this just seems like, a complicated version of a peer-to-peer lending model. So as you know, I'm pretty sure it would be the same thing in US, but in UK, there were a lot of peer-to-peer lending models, and that came to Australia as well. And a lot of people were like, the peer-to-peer lending models also democratized private credit in a way, where if somebody wanted a personal loan of, let's say, $30,000 to buy a car, they can just do it. And it's the crowd that is giving the money, pooling in the money, and then the borrower is getting it. There is an insurance set up by the credit platform, the peer-to-peer credit platform as well. So the insurance is taken care of. Our data is taken care of by the centralized entity. There is a customer service as well. If there is a breach, they're going to take care of it. So why would someone go to a protocol like Goldfinch where there might be a smart contract exploit? I need to take care of smart wallets. The security is my responsibility. I still need to pay a fees, and it's, a 10% fees based on the business model infographic that was shown that goes to Goldfinch. Similar margin is by the peer-to-peer lending models in the Web2 world as well. So my question to you is, and I'm curious to get your take, and I'll go second, why would somebody use Goldfinch when there is Web2 finance companies that democratizes personal loans and allow borrowers to get $30,000, $40,000 loan if they want, or if somebody wants to get a 10% interest when the bank is giving them 5% interest. So why would you use Goldfinch when there is peer-to-peer lenders available?
I think that's totally fair, and this is part of the reason I think it's going to take a long time. So, we were showing the centrifuge interface there, where if you want to be a lender and go in there and give up your capital to earn some of those fees, like, are you going to do that? Or are you going to buy like a U.S. Treasury or stock? Or like, I don't think there's an incentive for the lender side to come into this just yet. The reason that you've got sort of the 500 million or so of assets that have already been issued on chain is, to me, because those borrowers are trying to get a lower cost of capital, or they aren't able to get those loans through traditional channels. So you're getting the worst type of borrower, I think, at this really early stage, right? It's not a knock on centrifuge or these other protocols. You got to start somewhere to bootstrap this liquidity and like prove out these business models. That's where we're at, right? Like everything you just raised, I think is valid. Ultimately, I think the benefits of this can be realized, but some of the challenges are just like the chicken and egg problem with liquidity, all of the challenges with friction when you start to bring in, legal contracts and all of the friction related to the real world, recourse, like you mentioned, if something goes bad and somebody doesn't pay, like there's just a lot of complexity when you start to go real world to on-chain. And it might make sense to sort of, as we wrap this up, maybe I'll just pull up some of the differences with the assets and we can kind of go there. And then maybe we just wrap up with, I think, some of the challenges and why this is going to take longer than maybe people think. I think this is why I think this will eventually happen. Okay. So this is like the bullish side of it. And then maybe we can talk about the challenges. These are just some of the differences to me in terms of tokenized assets versus like traditional assets. You have the 24/7, 365 trading potential global, right? No single jurisdiction. Challenge here is when you do have, regulated assets, existing securities, there are different, legal requirements in different jurisdictions today. And so how do we start to break down those walls? Because these are like peer-to-peer global markets. We need to kind of find a way to do that. The assets themselves can be multifunctional. This is like something that I think is a little bit underappreciated in terms of like the asset itself can do different things when you could self-custody it. So if you have a piece of real estate that's sitting in a self-custody wallet, you can very easily use that as collateral on a loan, potentially, right? This is sort of the best case scenario, whereas there's a lot more friction related to doing that today and probably the traditional base. We'll see, but you really need to bootstrap that liquidity, bootstrap all the infrastructure to make this happen. We talked about just the accounting kind of perspective of this, of like having everything on a shared ledger, just, reducing a lot of the friction and reconciliation and all the challenges that come with that. Again, this is the big thing you'll hear with, tokenizing these assets is, we can make them more liquid. And if you make them more liquid, people could trade them. You get better like price discovery and all that. But it's a chicken and egg problem. We just don't have the liquidity to kind of bootstrap that today. Somebody will do it. I think eventually like a large asset manager like BlackRock or something is going to eventually do that, but we're still not there. Ability to self-custody, again, I think that's ultimately where the market goes, where people can self-custody the assets. You need to have insurance. You need a lot of different things around that, so people aren't just like losing tokens that represent real-world assets. That's another potential benefit. Because these are on public blockchains, the users themselves have access to clearing and settlement, peer-to-peer settlement, instant and final settlement. We talked about smart contracts and just the way to automate kind of the back end administrative aspect of this, democratizing access. So I won't go through all of this, but this is just kind of the bullish case. And maybe we should talk a little bit about just like some of the challenges, to wrap this up.
Yeah. I mean, when we talk about challenges, firstly is, again, as you mentioned, the chicken and egg problem. There's not enough assets out there. There's not enough then quality of assets out there. People still do not know how to interact with Web3. And I just think that is a learning curve that is still prohibiting Web3 to have that chat GPT moment. Like everybody is interacting with AI now. Literally everybody is interacting with AI. My 60-year-old mom in India is interacting with AI using Microsoft Edge as the browser. So everybody's interacting with AI, but I just think that this smart contract, this smart wallet interactiveness is still a challenge for a lot of people. That infrastructure friction is causing a lot of people to not enter the Web3 finance world. So I think that's a big friction point as well.
Yeah, I would definitely agree with that because, your mom can interact with ChatGPT. It's just a browser. She doesn't need a MetaMask wallet. And like, there's just imagine trying to get her to invest in real estate and do it with a token. And, it's almost impossible. So the UX is a major issue that needs to improve. Couldn't agree more on that. And like, I just think, the scalability problem of existing, like the Ethereum ecosystem itself, still not quite there. There are other blockchains with more scalability. We think, Ethereum's going to scale via L2, so that should get solved, but probably years away there. The other thing is privacy. So we didn't talk about this, but, we've talked in previous episodes about layer 2s and zero knowledge proofs, introducing this, functionality where we can prove what happened on chain on a public blockchain without revealing all of, who bought, who sold, who owns what, which most people aren't going to want to see or have as public information. That's a challenge. Ernst & Young came out with a privacy-focused layer 2 recently to solve some of this and to get corporations and these more institutional players to come on. Haven't seen like that really take hold just yet, but that's obviously another challenge. The other thing is like the data informing these assets, right? Like if I'm a borrower or if I'm going to buy a tokenized asset, I need to be able to click into that thing and understand. I need to see like audited financial statements and like understand the nature of the asset and trust that underlying data. We have in traditional markets, we have, a process every quarter where public companies go through audits and the market can trust the data underlying that. We don't have that in these markets just yet. So there's a lot of infrastructure that needs to go into that. And then of course, the other major thing is like the liquidity silos. We talk about public blockchains on this show. That's ultimately where we think everything's going. But in this real world asset space, there are many players that are doing things on private permissioned blockchains today. That's where JP Morgan is putting their assets right now. We think ultimately it is going to go into public chains, and one of the reasons for that is like it doesn't make sense to have all these liquidity silos. Like the point of this is to get everything on the same ledger, and then you could access all those benefits. But that's another challenge currently. And then like incentives, I always look at the incentives. So what are the incentives of the players that would need to come into this? So when you think about, when I was in Invenium, which is a startup that is focused on the data layer, so basically the data underlying private assets informing price discovery of these tokens. One of the challenges that I would incur at Invenium, when you talk to general partners, right, you need the fund to tokenize to like bootstrap that liquidity. This is the chicken and egg problem. But a lot of the general partners of these funds, like they don't really want to give their LPs liquidity. Like they kind of like that their LPs are locked up for 10 years and they're paying fees to them. It's like, why do I want to give them liquidity? And then the other thing is like, they sort of like the fact that it's not super transparent as well. And that they also don't have to mark down their assets. Like if you have liquid markets, then the assets will get marked down during a bear market in ways that they don't get marked down during today because we don't have the transparency and there's less regulation on it. So why would they be like excited to tokenize and they have to pay to do that? And so it has to come from the LPs, right? The limited partners, they're the ones that want the liquidity. So at some point, there needs to be a tipping point where there's so much the LPs or some other GPs have tokenized so that the competitors have to do it as well. We'll see, but a lot of challenges. This was not one of the things that I was bullish on for 2024. I am bullish on this space ultimately coming to fruition. I think it's years away currently.
I totally agree with you. I think it's years away. That's why in our 2024 prediction, the first episode of the rundown for the year 2024, we really didn't cover it, but you're spot on. Literally anybody that I speak with, they're like 2024 is going to be the year for real world assets. And I'm like, really? I don't think so. And it's precisely for those reasons. Talking about privacy, one of the news that I heard a few hours ago before coming on the studio, Binance delisted Monero and Monero crashed significantly. And Monero, as you would know, one of the most private, digital crypto tokens out there. So massive blow for a lot of people who are into using these native crypto assets for privacy reasons, whether it's conceptually or for libertarian reasons, but massive blow for the community there. But yeah, like just interested before we wrap it up, what is your take on the continuous delisting of privacy protocols or privacy coins like Monero?
Yeah, good question. I didn't see that news. I'm curious what's going on there. That must be coming from the government or something that putting pressure on Binance to delist. So I guess that's to just sort of separate Monero and privacy related, like Monero is basically a block, and correct me, maybe you know better, basically a blockchain that enables privacy related payments. So if I sent you on Bitcoin, anyone can look at my address, sent a transaction to your address. They don't necessarily know that I'm the individual behind that wallet address, but that's all traceable. And on Monero, that's made private, correct? So you can't even see the interacting wallets.
Yeah.
Yep.
So Monero, so, we both go way back 2016, 2017 days of crypto. Monero is one of the OG crypto tokens. It was started in 2015. And Monero uses a very different type of technology called the ring CT technology rather than ZK snarks in order to create that confidentiality layer towards this transaction. Biggest differentiator that Monero users say is that you can see a rich list, the famous top 100 token holders, rich list of any tokens. You can't see the rich list for Monero just because it is so private. But yeah, just as a last anecdote, because I've done a lot of research on Monero back in my days. Monero was actually told by one of the FBI professionals when he came to do a guest lecture that FBI has the ability to trace literally all tokens. This is I'm talking about in 2017. I heard this where the security professional mentioned that they've got the ability to track all digital tokens. And as you know as well, Bitcoin, it's highly opaque. There are so many tools out there that can track Bitcoin activity right to a certain IP address even. But the FBI security professional suggested that Monero is the only one that they are not able to track. So yeah, I think I haven't read the full news, but there must be, some of that activity that CZ pleaded guilty, and a part of its ramifications that Department of Justice is now coming hard to any exchange that is probably allowing trading of Monero.
Interesting. It is interesting. And we saw like Tornado Cash get shut down as well. Anything which is, I think, probably using some similar mixing type tech so that you can't identify it. This is very different from privacy focused layer 2, which you would be able to, I guess, those transactions would not be made public for anybody that's just observing what happened on the blockchain, but you can prove the underlying activity, what happened. I think the government's fine with that. That's actually what everybody wants. Where, okay, we have privacy, but we can prove, what happened underneath. And I think that from the government's perspective, they're like, this Monero thing, Tornado Cash, like these things scare them because you actually can't trace that stuff. And we know like Elizabeth Warren is out here pretending that that's how Bitcoin works. And that's actually how Monero works. She should be focused on Monero and maybe not Bitcoin. Who knows? Maybe that's tied to why Binance just delisted Monero. Who knows?
Amazing. Talking about next week, Michael, what are we going to talk about next week?
So what I want to get into, and we are starting to get at the DeFi report, we've been thinking about putting together a Solana investment framework. And one of the things that I've been really focused on is really nailing, like Solana has seen like a lot of action and the market's been pretty active around Solana. So I'm sort of honing in on my thesis of Ethereum versus Solana. So I'd love to talk about current thinking on Ethereum versus Solana next week. We'll have some data to share and also just like more of a qualitative view of like how I view those two networks. But yeah, hopefully that's exciting for people.
Amazing. Look, for everyone out there, I hope you enjoyed this power-packed episode, got some exposure to a little bit of TradFi concepts of the private credit market and also the future of finance on how a lot of these financial markets are going on-chain into the Web3 blockchain world. Michael showed, Centrifuge. Michael showed Goldfinch. He got the token terminal fired up to actually show the underlying data and how all of these protocols, like for MakerDAO, for example, is generating so much of fees in the last 1 year. So there is fundamental behind the activity and the speculation as well that we are witnessing, and also the hype that we are witnessing, that tokenization and hopefully real world assets and probably in a decade's time is the future of finance. So I hope you all enjoyed this episode. If you do find it valuable, please share it with your friends, with your TradFi friends, with your brothers. Is your brother into crypto now, Michael, or we need another quarter for that to happen?
We've got like a bit of a divided family on this right now, and maybe that's something we should do at some point is have a crypto skeptic on, and we can sort of like get that perspective on this show. I think that would be exciting to have someone.
Do you have some names in mind that we should
I'm looking for them. I've been just throwing out the fishing pole on LinkedIn, seeing if I can catch somebody. We haven't caught anyone just yet, but I am noticing there's more, I would say, the no coiners, we call them, the people that just sort of really don't like crypto, are showing up in my comments more on LinkedIn. It's probably because we're like the bull market vibes are coming back, and people are. I just find the psychology of the no coiners just really fascinating. So no, maybe at some point we'll get somebody in there, and I'll invite them on the rundown to share, to get into more of the nuance of their views.
Amazing. So on that note, guys, thanks a lot for tuning in for another episode, and thanks a lot, Michael, for a great episode like always.
Likewise, Shiv. Thanks, everybody.